The stock market is returning to its fundamentals after the panic about the epidemic recovery. Dividend stocks are the way to go, to put it simply, in a world of high inflation and rising interest rates. For today's video, we will be going to talk about Michael Burry predicts the biggest market crash. Are you curious about these super investor stocks to purchase? Just keep on watching. Meta. Of course, Meta owns Facebook, Instagram, WhatsApp, and Messenger, and they generate 97% of their income from advertising. And because each of Meta's apps has such a significant network impact, the company is tremendously powerful. 2.82 billion individuals, or 36% of the world's population, now log onto one of Facebook's apps every single day as a result of this. And because that's where everyone is, that's also where the advertisers are. As a result, over the past 10 years, Meta has been able to boost its revenue by an average of 41.3% per year. Additionally, they have maintained 10-year compound annual growth rates of 45% for free cash flow and 46% for earnings per share. It's a fantastic company with 16 billion in cash on hand and no debt, and a 10-year median return on invested capital of 19.3%. What's changed now though? If you look at the stock, which is down 38 since their most recent result announcement on February 2nd, the firm is still operating normally. It isn't 38 worse than it was 3 weeks ago, and the internet didn't go up in flames. The fact that the company is now valued 37 to 38% less than it was a few weeks ago, while still having a large moat, a very competent management team, and a strong balance sheet, is due to what Facebook stated in that earnings announcement. First of all, given what we just discussed, it's a little difficult to judge their user growth. However, they also stated that they expect 27 to 29 billion in revenue in the first quarter, which is slightly less than the 30.15 billion that analysts were anticipating. This figure also represents a 3 to 11 year-over-year growth rate rather than the enormous 20 to 30% year-over-year growth numbers that Facebook shareholders have grown accustomed to. Facebook claimed that this decrease is primarily the result of advertisers cutting back on their advertising budgets and order to hang on to one money while navigating. They mentioned supply chain problems, a shift in customer preferences towards Reels, which are less profitable, and Apple's new iOS privacy rules. Although there may be headwinds, this firm is still very young, and it is currently 38 cheaper than it was a month ago. Therefore, even if they invest in it today, they are likely still seeing rather good long-term returns in their views. Amazon. 12 super investors purchased Amazon last quarter, and if they had purchased towards the end of the previous year when the price was essentially flat, they would undoubtedly have purchased following the stock's January decline. The stock lost around 18% of its value at the beginning of the year and has lost about 12% so far this year. On the one hand, it's still quite pricey, albeit less so that in the past. It has a PE of roughly 50. When it comes to long-term compounders, Amazon is unquestionably one of the best examples available. You would be cursing yourself right now if you had passed on Amazon 20 years ago, because it had a P of 50, 100, or 200. They have served as the best illustration of how to generate some money, reinvest it, and let the firm continue to grow organically. And as a result, they have achieved outstanding 10 years AGRs of 25.6 for revenue and 47.1 for earnings per share. Intriguingly, though their revenue isn't all that large, this is because, unlike a company like Alibaba, Amazon strategically chose to have total control over its entire customer experience from beginning to end. Additionally, there is a significantly lower profit margin when you invest heavily in, say, the delivery aspect of online purchasing and e-commerce as opposed to, say, simply hosting an app or Amazon Web Services. MasterCard and Visa. As a result, each of these stocks saw 11 super investor purchases during the quarter, which was likely a result of their respective declines in the fourth quarter. These companies enjoy significant competitive advantages. Visa and MasterCard are therefore both payment processors. Therefore, when you use a payment card that bears the logos of Visa or MasterCard, it is Visa and MasterCard's responsibility to establish a connection between the acquirer and the issuer. To expedite the transfer of funds to complete the transaction, you would connect the grocery store's bank account to your own bank account. They therefore have the necessary equipment to process these payments swiftly, accurately, and safely. They do so for a very modest cost for every transaction, but even this small amount soon mounts up because 232 billion payments and cash transactions, or an average of 637 million transactions each day, were processed through Visa alone in 2021. As a result, these businesses are able to generate significant profits with a relatively little share of each transaction. Visa and MasterCard have benefited greatly from a strong network effect, and because these businesses introduced the MasterCard and Bancomer cards first in the market, their network effects have consistently maintained them far ahead of all other competitors in their sector. In 2020, Visa had a staggering 52% market share, followed by MasterCard at 22% and American Express at 9%, showing that it was by far the most popular payment method. It's not unexpected that some of the super investors purchased both of these companies, given that MasterCard's overall slide began at the beginning of December, and that the stock price of Visa fell by as much as 18% in the fourth quarter, a decision that, thus far, would have generated favorable results. Comcast. So, Comcast is a major, established global media firm with a US-based. The three main business divisions of this company are Comcast Cable, NBC Universal, and Sky. Therefore, in 2021, cable accounted for 53 of their revenue, followed by 31 from NBC Universal's media studios and theme parks, and the final 16 from Sky. Therefore, under the Xfinity name, the cable communications industry offers broadband, video, and wireless services to residential users in the US, as well as to companies. With 31.7 million residential users and 2.5 million business clients as of the end of 2021, NBC Universal is divided into three business divisions. The term media here refers to television and streaming services, such as all of their cable networks, broadcast networks, local television stations, and of course, Peacock, their streaming service with 25 million active accounts. Then comes to their production and distribution businesses for their television and film studios, followed by theme parks like the Universal Studios theme park in Orlando, Hollywood, Osaka, and Beijing. Lastly, Sky. Their third major business area is a significant entertainment firm in Europe that is well known for its sports and news networks. Therefore, Comcast is plainly large, experienced, and diversified, and the financials demonstrate that over the previous 10 years, this revenue has grown at an average rate of 12% annually. Free cash flows are increasing at roughly 11 per year, while earnings per share is increasing at 16. Comcast is already a hugely successful company that is aware that what they are doing is effective. They therefore own Sky, have a reliable internet and cable business, as well as well-known media properties and theme parks. As a result, they continually repurchase stock and earn a lot of money, doing the same things year after year. Additionally, they distribute around 30% of their net income as dividends. Thus, they appear to have moved from that period of growth to the phase of returning cash to shareholders. So, which investor stock do you think is the greatest one to buy? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.